All right, guys, Mick Satcher again from sellmymortgagenoteforcash.com. And today I am going to be giving you another tip here to figure out how to create the perfect note and how to maximize the note's value. If you haven't already, please go to my website, sellmymortgagenoteforcash.com. The link is below. And by going there, you'll get access to my free guide, that a step-by-step blueprint that I created called the Note Holder's Guide. Discover how to maximize your note's value. And it's going to give you everything you ever wanted to know about creating the perfect mortgage note. Or it's also going to give you all the information that you need to figure out what your note is worth and how to possibly sell it to someone like myself who is a private mortgage note investor. If you don't know it already, I actually buy private mortgage notes. And basically what that means is maybe you sold a house and you sold it for $100,000, but the buyer only had $70,000. But instead of not selling the house to him, you decided for the remaining $30,000 that basically you were just going to write a mortgage, and you were going to say to him, hey, instead of paying me the $30,000 cash now, pay it to me over the next 10 years at a rate of 7%, 10%, whatever. You basically, in essence, created a mortgage note when you did that. And rather than you waiting for the next 10 years and receiving $500 every month, I will give you cash for that mortgage note. And by doing so, what I'm doing basically is paying you cash. And then from then on, the borrower will pay me $500 a month instead of you. Okay, so that's basically what I do as a private mortgage note investor. If you haven't already, please go to my website, sellmymortgagenoteforcash.com. Look at the link below. And if you haven't, subscribe to this YouTube channel. Also, please give me 2 thumbs up, or 1 thumbs up only, sorry. Give me a thumbs up on this video. This way it tells YouTube that I'm creating something of value that actually people like, and it allows me to stay up on YouTube. Also, if you have any comments, questions, or anything like that, please comment below, and then we can communicate with each other that way as well. However, if you are interested in selling your note, please make sure you go to my website, sellmymortgagenoteforcash.com, because if you don't do that, then I won't be able to get in touch with you and offer you cash for your note. Today, we are going to be talking about note safety. And the aspect of note safety that we're talking about today is loan to value, also known as LTV. What exactly is LTV? Again, like I said, it stands for loan to value. Simply put, if you are selling a house that's worth $100,000 and you give the borrower a mortgage for $100,000, basically your loan to value ratio is 100%. Meaning 100 divided by the house value, which is 100. That is not a good note. Okay? Here's why. That basically means that the borrower put $0 down or 0% down. That's not good. What you want is a low loan to value ratio. Someone like me, if I'm considering buying your mortgage note, I want to buy a mortgage note where the borrower actually has some skin in the game and he actually put some money down. For example, if you sold the house for $100,000 and let's say they put $10,000 down and you gave them a note for the remaining $90,000, that's a better note. So now in that scenario, the loan to value ratio is 90%. Which is 90,000 divided by 100,000, which is 100,000 is the house value. Okay? So when you're creating notes, you want to create notes that have a low loan to value ratio. Meaning, in other words, you want to create notes where the borrower gives you the maximum amount of money that you can get down. By doing that, you are creating a better quality note, making it easier for you to sell that note to a private mortgage note investor like myself. I would much rather, if all else being equal, if someone's credit was perfect, their job history was good, the house value was 100,000, and you approached me and another guy approached me and said, hey, Mick, I have a loan here, like a note here that I sold the house for 100,000. This guy only put $5,000 down and this guy put $20,000 down. So now the note with the $20,000 down is only 80,000 note, and the other guy's note is for 95,000. Which note do you think I would buy? Or which note do you feel that I would be more interested in buying? Let me tell you, I would be more interested in buying the low loan to value, the low LTV note. I would much rather buy the $80,000 note than the $95,000 note. Why? Simple. The borrower who put $20,000 down has more to lose than the other person who only put $5,000 down. So, if I'm an investor and I'm doing this for a living and I want to make sure that my investment is safe, I'm definitely going to be more interested in the lower loan to value ratio notes than the higher ones. Okay, I hope that makes sense. It's something that you want to keep in mind at all times when you're creating mortgage notes. And basically, the lower the loan to value, the lower the LTV on your note, the more valuable your note is. So definitely keep that in mind when you're creating notes. I hope this kind of makes sense. I hope you enjoyed it. Please give me a thumbs up. Please subscribe to this YouTube channel. And please share this video with your friends on YouTube, Twitter, whatever it is. Whatever, twitting or Facebooking or whatever you do. Man, there's so many different things out there today. It's crazy. But anyway, thank you so much for being here. And I will be making another video very soon. And I will see you on the next video. All right. Thank you.